morning and welcome. Patriot Radio News Hour. I'm Joe Jaquint. Happy Tuesday. The countdown to Old St. Nick is in full effect. What are we? A week away from Christmas. I hope today finds you well. The sun is out. The birds are chirping. And we're rocking and firing here in the Hole in the Ceiling studios. 800-951-0592 is our toll-free number. Legal, lawful, constitutional tender. It is what we do. The website at allamericangold.com. And, you know, I'll say this. Next time I get a really great idea, talk me out of it. Colorado, I think we're on. I'm not sure that we're on, but I think we are. I know that yesterday wasn't the greatest day. It is getting better. We're working on it. I promise it's not going to take long. We're going to be there, and we're going to be there real quick. Hang in there. We got, when it's all said and done, I will say this. You're going to love it. You're going to be so thankful because it's going to be, a lot better than how we found it. And I think that's one of the great things about us. Speaking of better, well, or maybe not better, Wall Street, another big down day yesterday. Today it was rallying that it's early, but you never can tell. The Dow is up 200 right now. We'll see if it lasts. I worried about crude oil. I've been talking to you about crude oil. Crashed today, down almost 5%, now $47 in change. That's not, I hate to say, it's funny, that should be good news. It is, but it isn't. It's good news when the gas prices fall. I saw it today, $2.71 here, and I don't get it. I mean, it should be like, $2.40, $2.30. Why is it still $2.70? I don't know, but still $2.71. That's down, about 25 cents from the high. But crude oil breaking below 50. We're probably now going to start hearing about bankruptcies in the oil area. That really is going to put a dampen on drilling and things of that. And at $70, $80 a barrel, they were making good money. Now below 50, you got to be smart. Some places you can, other places you cannot. A lot of things that we are going to talk about. My favorite people were out. Matter of fact, out on our website, a great interview this morning. We're actually going to play it here with Stanley, or it wasn't Stanley Druckenmiller. He did the op-ed in the Wall Street Journal, but it was Jeffrey Gundlach that did the interview with CNBC. Listen, you're going to want to pay attention. And all you can do is, right, you connect the dots, and you try to put it all together and draw conclusions on where things are going to go, and you start looking at data points today. The biggest economic data out today was single-family and multi-family construction. And what we learned today, everybody apparently is going to live in an apartment. I mean, that's really what happened. They are construction. These are in the process of either being permitted or in the process of being built. Single-family housing starts fell more than 13% year over year. I mean, it's incredible. It really is. But don't worry. Construction of apartment buildings, well, they were up and up big. Matter of fact, sales of construction of apartment buildings, not sales, construction of apartment buildings up 20%. So there's a great indication. You look at this town, Phoenix, I want to say, well, we got to be like the apartment capital of the world now. Everywhere I go, apartment. See, they already know. This is where everybody is going to end up because, first of all, no one can afford a home. And I will say this, the affordability may start to get a lot better. I just got a text from Jason. Listen, by the way, and I know we make fun of Jason a lot, but for those of you up there in Colorado, Jason runs our Colorado office for you Phoenix folks and everybody else who's listening. Give him an attaboy. He's working his hind tail off. Him and Brian both. It's been a tough 24 hours, but apparently we are on the air, and I've got a funny feeling in the next 24 hours there's going to be a great improvement in what's happening there. But nonetheless, housing is, you got to put 20% down, like the old days. And nobody has the money, right? At best, maybe you're fortunate enough, and I'm talking about the younger generation now, that you can pay all of your bills by yourself without mommy and daddy. That's if you're lucky. We've got a great story about that as well. How much are we really spending on our adult children? You're not going to believe. Are you an adult if you still need mom and dad to get by? And really, why is it? Because I'm going to tell you this right now. I know these millennials. I've coached most of them. I know these kids. They're no different than I was. You were. Your friends were. They want to work. They want to be productive members of society. The Central Bank has made sure they're going to be broke forever. We'll be back after the break. 800-951-0592. That is our toll-free number. And I say it to you all the time. Don't take my word for it. I want to educate. I'm not here to scare anybody. And people don't say that as much now. They used to. But that's not what we're trying to do. We don't want to scare anybody. We want to educate. And don't just take my word for it. And I've given you the names of a bunch of people throughout, the years that I've been here, the people that I like, the people that I trust, and the legends of the industry, guys like Chanos, guys like Stan Druckenmiller, guys like Jeff Gundlach and Ray Dalio and others. These are guys that aren't gold bugs, right? We just believe in gold. That's not these guys. These guys are billionaires. These guys are the ones that the other billionaires give their money to make them even more billions. And they've all been out with some incredible warnings. We're going to play a clip. This is also, by the way, on our website today. And actually, today is one of those days. Ramon, by the way, you did a great job today. Great stuff out there today at allamericangold.com. But we're going to hear from Jeff Gundlach. I'll cut in here and add a little color to it as the interview takes place. But talking about the bond market. Okay, so this is the guy. He's the kind of like the new bond king, if you will. The warnings and the predictions that he makes. And again, remember, I want you to be ready. I want you to prepare. I want you to be able to prosper when others aren't going to be able to do so. Ramon, let's start playing them.
So I've had a call for the last over 2 years that come 2021, the 10-year Treasury will be at 6%. And I get a lot of pushback. There's a lot of debt deflationists out there in the Twitter sphere and the blog sphere, and they say you're absolutely wrong. The economy can't handle higher interest rates. But, interest rates might have a life of their own. It might not matter what the market can handle or can't handle.
They haven't to this point.
Stopping right there. So think about this. You already know, because I've educated you. We've got a 10-year note today. That's what, in the 2.8 something percent. And the small national debt number is $1 trillion for the year. At And remember, and here's a guy, he puts his money where his mouth is. 2021. Listen, we're 2 weeks away from 2019. This is a very small window. And, of course, everybody, and he's right, everyone, oh, no way, we can't do. I'm already going to tell you, I think that he's right. And quite honestly, the size of the national debt with a 10-year note yielding 6%, forget about $1 trillion. Forget about $2 trillion. Will be $3 to $4 trillion a year. You better get ready. Let's keep playing them.
And somewhat surprising that rates have remained where they are. I mean, you said 3%. They hit 3%, 3.25, got to 3.25.
Yep.
And here we are below 2.9 today.
Yes, on the 10-year. I was really focusing on the 30-year, which I thought when it broke above 325, that was incredibly important. Frankly, I didn't think we'd ever go back below 325 once we broke above, because it seemed like such an important level. But here we are, we're back below 325, but not impressively. Not in a way that would be consistent with a big decline in the global stock market. There's a thing called a death cross. It's the 50-day moving average goes below the 200-day, and particularly when they're both declining, it's a death cross. Presently, about 80% of the countries in the MSCI World Index are in a death cross. 80%. It's amazing. And there was a chart that got a lot of play that was put out by Deutsche Bank about how many risk assets globally are in officially bear markets, down that arbitrary 20% number that, again, I don't really ascribe to, but it's so commonly used that they used it. And it's like the highest in the data series, going back to 1901. It's like 90% of the risk assets around the world in dollar terms are in bear markets. So it's a pretty widespread and coordinated set of weaknesses.
Are you saying that by embarking on this suicide mission that the Fed shouldn't raise interest rates this week?
I don't really think that's the main thrust of my idea. It's and this week, yeah, I think they shouldn't raise them this week. I agree.
You think they shouldn't?
No, I don't think they should. The bond market is basically saying, Fed, you've got no way you should be raising interest rates. Look at the 2s, 3s, 5-year part of the yield curve, which are flat at 270. I mean, I guess that is corroborative of maybe a hike, but it's basically
right there. Hold it right there. So now he's talking about, obviously talking about all of the bear markets happening, and they're acting like they're not there. They're there. Then talking about the rate hike that we're supposed to get tomorrow. And telling you, listen, the bond market is clear. It's telling the Fed, don't hike. Something's wrong. And the funny part is, remember now, the Federal Reserve is trying to convince you that the bond market doesn't matter. Right? Oh, don't forget, I know that it always tells us when the recessions are coming, but it doesn't matter this time. And, of course, the bond king's saying, it matters. Now, I don't think the Fed is listening, but trust me, it is going to matter. Go ahead, Ramon. Keep playing.
That in the year 2019, you're going to have a cut this big, but a cut. That's what's priced into the yield curve. And in 2020, another cut. So the problem, though, isn't that the Fed shouldn't be raising rates. The problem is the Fed shouldn't have kept them so low for so long.
Sure.
The problem is that we shouldn't have had negative interest rates like we still have in Europe. We shouldn't have done quantitative easing, which is a circular financing scheme. But the problem really is the deficit. The Fed is kind of helpless here. The fact that the deficit is so out of control this late in the economic cycle, we have never before had the Fed raise interest rates while the budget deficit was expanding. It's never happened because usually the budget deficit expands in response to a recession. It's a way of stimulating to get us out of recession. But instead, we did it as a last gasp of keeping this economic recovery going by making it completely deficit-based.
So this morning, President Trump once again tweeted about the Fed, quote, "It's incredible that with a very strong dollar and virtually no inflation, the outside world blowing up around us, Paris burning, China way down, that the Fed is even considering another interest rate hike. Take a victory, he said. Stan Druckenmiller today, op-ed Wall Street Journal. The Fed should, quote, pause its double-barreled blitz of higher rates and tighter liquidity. So they're right. You agree with them?
I do agree with them. I've been saying this pretty much all year. The double-barreled was actually, I mean, he may have borrowed that from me. That's what I've been talking about. That's how I've been phrasing it all year, that we're really been tightening interest rates in a way that's more than people understand. There's a duo of economists at the Atlanta Fed called Wu and Shaw who did a study a few years back. What was the effect of quantitative easing? If they hadn't done the quantitative easing and instead had taken the European model and gone to negative interest rates, how negative would those rates have had to be to have the same stimulative effect as the quantitative easing? And they concluded, and I don't know if they're right or not, it's very hypothetical, but their conclusion was that the quantitative easing amounted to 300 basis points of further cuts. So if they hadn't done quantitative easing, to have the same stimulative effect, Fed funds would have been negative 300 basis points. Well, let's just say they're right. Since they did about $2.5 trillion of quantitative easing, and it was 300 basis points, $2.5 trillion divided by 3 is roughly $800 billion. Okay? So $800 billion is divided by 4 means that's what quantitative easing is one cut. So 100 basis points is 800 billion, so divide by 4. 25 basis points is $200 billion of quantitative easing. Well, so far, we're pushing towards 400 billion, and we're not there yet, but we're soon to be there, of quantitative tightening. That means we've had 2 more rate hikes from quantitative tightening if Wu and Shaw are right. So the Fed hasn't just raised rates in that context 8 times, they've raised them 10 times. And the quantitative tightening is stated to be as high as 600 billion over fiscal 19. So that's another
right
3.
There, hold it right there. So what he's talking about is the unwinding of the central bank's bond buying program. Remember, they created $4 trillion out of thin air. That's how they saved the banks, right? They bought all that debt. They bought mortgage debt. They bought securities. They bought treasuries. And really what he's trying to let you know is that's another form of tightening, and policy is even tighter than that. And he expects all of that to end, right? Did you hear him? 2019 is going to be rate cuts. I think before the rate cuts, you're probably going to get what? Hey, we're going to stop doing the balance sheet, plus we're going to do rate cuts. Then he said 2020 is going to be rate cuts as well. And remember his prediction for the 10-year note. He doesn't think that and I hope he's wrong, but he's a really smart guy, that even though we'll be cutting, that rates are going to be rising. You look at the Treasury Department today issuing these reports about bond holding. Right? China continuing, it's slow, but now their bond holdings are the lowest in 18 months. Right? They keep selling. Japan keeps selling. Matter of fact, really the only buyer out there, it appears, pension funds. And we know the shape that they're in. But this is what he's talking about. So when you hear that last, don't get confused by it. Listen, the Fed is trying to sell some of those securities that they bought, because they know holding them is going to be a big fat loser. But I'm going to tell you right now, they're running out of time. Ramon, go ahead and finish with the clip.
Rate hike. So if they were really going to follow their dots and raise rates so many times, there's another 3 on top of that. So the amount of tightening has been underappreciated, I think, and Stan is right, as he often is one of the greatest investors ever. For him and Chanos, I think, are the two titans of the hedge fund industry. They're right that we are seeing the bond market react in a way that is historically very predictive of the Fed should not be doing this. And yet we have this strange dynamic that they've almost promised a rate hike here in December, and then the president shows up with his tweets trying to bully them into not doing it, and it puts Jay Powell and the team in a very tough position, because they're damned if they do and they're damned if they don't.
So, again, when you sit there and you listen to logic, we have a very clear pattern that the bond market is telling the Fed that they shouldn't be hiking interest rates that they've already over-tightened. And remember, I told you, listen, they've got the history. The central bank has the history 100%. They're perfect. I mean, you think about it, right? When your kid comes home from school, hey, I got 100 on my test. You're like, yes, way to go, son. Way to go. Way to go, honey. Great job. Unfortunately, the one thing the Federal Reserve has gotten 100% on isn't good, which is they overestimate their own abilities. And every time they've gone into these quote-unquote rate hiking cycles, they put us right back into recession, and it's happening again. And all the signs are out there, and it really doesn't matter. As he talked about, listen, forget about just the U.S. side. 90% of paper markets are in bear market. Patriot Radio News Hour. We'll be back after the break.
This is the Phyllis Schlafly Report, a daily commentary continuing the conservative pro-family legacy of Phyllis Schlafly. Now, the president of Phyllis Schlafly Eagles, Ed Martin.
As most high school students know, and American history clearly demonstrates, the modern concept of birthright citizenship really is simply wrong. Indians living on reservations were not American citizens for most of our history, despite being born in our country. Native Americans were considered members only of their sovereign Indian tribes until Congress extended blanket citizenship in 1924. Similarly, children born to foreign ambassadors while in the United States are not American citizens, but are citizens of their country of origin. In their crusade against President Trump, globalists trot out alleged experts claiming that Trump's proposal to end birthright citizenship is impossible, unconstitutional, or morally wrong. But the hysterical overreaction by his critics proves how right Trump is. Omar Jadwat, director of the ACLU's Immigrants' Rights Project, said the president cannot erase the Constitution with an executive order, and the 14th Amendment's citizenship guarantee is clear. This is a blatant, unconstitutional attempt to fan the flames of anti-immigrant hatred in the days ahead of the midterms. In fact, the last time the Supreme Court addressed the issue of birthright citizenship was 120 years ago, in the case of a child born to a lawful permanent resident who had what is now called a green card. The Supreme Court has never decided the citizenship of those born to persons unlawfully present in the United States or lawfully present on temporary visas for tourism, education, or temporary employment. The ACLU was also bitterly opposed to Trump's policy of vetting travelers from countries that are hotbeds of terrorism. Globalists falsely characterized that policy as a Muslim ban, but it was upheld by the Supreme Court last June. Trump's new executive order should fare just as well when it gets to the court. Trump's announced intention to fulfill his campaign promise capped another week of setbacks for globalism. In Brazil, which is called the second largest democracy in the Western Hemisphere, the conservative nationalist Jair Bolsonaro won the presidency by a landslide of 55 to 45%. That adds Brazil to the United States, Hungary, and the Philippines, where conservative nationalists have triumphed on Election Day.
This has been the Phyllis Schlafly Report from Phyllis Schlafly Eagles. It's no secret that globalists are bent on destroying Western culture. Whether the threat comes from inside or outside our borders, America must be protected from cultural Marxism and those who would deny American sovereignty. We're seeking your insight at phyllisschlafly.com. That's phyllisschlafly.com. And join us again for the Phyllis Schlafly Report.
800-951-0592, Patriot Radio News Hour, talking about the Bond King, one of my favorite guys in the investing arena, telling you, hey, listen, the bond market has already told us where things are headed, and I'm worried. I hope he's wrong, but he says by 2021, the 10-year note will yield 6%. And you think about history, that's not even a big deal. That would be slightly below average. That to be slightly below average. I think average would be probably 7.5, right? A 10-year or a Fed funds rate of, around 5%. But that's not what he said. He says he doesn't expect the Fed funds rate of 5%. He expects the Fed to be cutting. And yet the bond market will be going the other way. And again, right, we talk about this all the time. Where is the point? When investors start turning their back on U.S. Treasuries. I want you to know this. If the pension funds weren't buying, where would we be right now? Foreign governments, and it's not just China and Japan, they're the biggest. They're saying thanks, but no thanks. And then you start factoring in things, right? This is, the great economy, and you hear it all, the economy's so strong, it's so strong. Merrill Lynch just came out with their most recent study. And they found, and I knew it was a big number. I didn't know it was going to be this big. 79% of parents continue to serve as the family's bank for their grown-up children, paying for big-ticket items like college, weddings, and for smaller items such as, cell phones, health care, insurance, tires on cars, and the list goes on and on. Parents of adult children, according to Merrill Lynch, contribute $500 billion annually, twice the amount that they've invested in their own retirement accounts. And again, they can't make it. Remember when we were growing up? And I'm 48. Just, to give you some context. Couldn't wait to move out of your parents' house. But your parents couldn't wait. And when you moved out, you moved out. Mom and Dad weren't flipping you money for it. Matter of fact, you didn't want the money. Like the last thing you wanted to do was call your mom or your dad and ask for money. Right? You're like, you'd have to be starving or going to be homeless before you made that call. And you figured it out, but you could afford to do it. Can't afford it now. Have you seen and I told you, we're like the apartment capital of the world. Have you seen what it costs to rent an apartment here? It's incredible. I mean, these were, what these rents were? They used to be called house payments. More than a house payment. 63% of parents say they've sacrificed their financial security for the sake of their children. Right? And that's kind of what are you going to do? Because the alternative. The alternative is they're going to have to move back home. Here's what really was even more eye-catching. 34% of people 18 to 34. Right, 18 you can maybe understand. 34 lived under their parents' roof. 1 out of every 3. Of those, 1 in 4 of those people who were living with mommy and daddy didn't go to school, nor did they have a job. It's the greatest economy ever. Wow. You want to see adult children who are not being put in a position where they can be successful in their own right because they have a crutch which is different than an opportunity. Well, that's wishful thinking, right? I don't know what the answer is. When you sit there and you think about how does this happen, how does 79%. See, 79% is not a crutch. When 79, let's round up, we make it. When 80% of people 18 to 34 still need to rely on their parents, it's not a crutch. Something's wrong, right? And they can say, "Oh, it's only 2% inflation." Obviously, we know it's not. No one can afford it. No one can afford 20% down for a house. No one can afford a house. Heck, these millennials, they can't afford an apartment. You know, one of my best friends, his daughter, who is 28 or 29, I think she's 29. She just graduated from ASU. And she took the hard road. Right? Her parents out of high school were helping her. She said she didn't want to go to school, this, that, and in her mid-20s decided, man, she's been working and going to school at the same time. And they announced to all of us that she is finally off the payroll at 29 years old. Finally off the payroll. They're not helping her financially. She's paying all of her own bills. She's got a good job. Problem is they got two other kids that are also in their 20s, both fully on the payroll. So, you know, 1 out of 3. Kind of what this thing said. And now it's starting to slow down. What's going to happen? What's going to happen when mom and dad can't afford to help support their 18 to 34-year-old children? What's that number? I mean, 34? What are we going to do? Oh, well, 40? 50? You know, where does it all end? Patriot Radio News Hour. We'll be back after the break. 800-951-0592. Make sure you get out to the website today. Really a lot of great stuff out there. Talking about student debt, talking about parents providing 79% of parents helping their adult children in as far as living expenses go. Then we had that great interview with Jeffrey Gundlach about bonds and where we're heading next. And they start looking at liquidity. Is there enough buyers for the debt that we're going to issue? And the one thing that I think is pretty evident is there isn't. You got to remember, they say $1 trillion, right? Which is, just so you know, last year they did what, 780 billion, something like that. That was the small number. So now they're saying the small number is going to be $1 trillion. Okay, so that's let's just call it. There's a 250 billion more in debt that needs to be bought by somebody. But remember, that's not the real number. Right? We really need to sell, like last year, we needed to sell 1.3 trillion in bonds. So let's be kind and say it's 1.5, 1.6 trillion, real number. Now you have the Federal Reserve who's not repurchasing a certain amount of bond. Now, this year, the 2019 was supposed to be a big year, something like $600 billion, and you heard Gundlach say that's not going to happen. That would mean that we would need to sell well over $2 trillion worth of debt just for 1 year. And everybody around the world, listen, everybody's slowing down. China's slowing. Japan may be in recession, right? Europe may be in recession already. where's all that money going to come from? And when you think about the logic that he's using, he's saying, hey, listen, there's not going to be all these people, and people will keep talking about disinflation and this and that, and bonds can't go up. And he's like, yeah, they can. They absolutely can. Especially when people don't have confidence in the quote-unquote full faith and credit. And you heard him say the Fed should have never have done what they did. Remember, right? We've got tools in the tool kit. Like they're a carpenter or an electrician. Oh, we've got all these tools. Well, you know what the tools were? The tools were, and these guys are academics. They were the things that they were taught to never do. And they said, well, you know what? It's an emergency. See what they really did? See, they thought they were putting water on the fire, right? Put the fire out. The problem is the fire that they were putting out was the grease fire. And now they've thrown all this water on it. And it's getting ready to explode. And I've been telling you this for a while. I've been preparing you. And so you sit there and you start thinking about, here we are at the end of this cycle. Never before. Did you hear the other thing he said? So the first time where we've seen the Fed raising rates, and the deficit skyrocketing. It's never happened. See, we used to follow this little pattern of, we're in a recession or the economy's slowing down, pick up the government spending. Right? That was always the solution. Pick it up. Now, here we are, we allegedly have this great economy, and the debt is exploding. And they're raising rates into it, and he says it's going to end horribly. And it makes sense. Really, it does, if you really think about it. You don't even think that hard. That makes no sense. Right? Why would you make it even cost even more? Now the government's out there borrowing. Everything has gotten to really, the numbers are ridiculous when you think about it. Right? $1 trillion a year. By 2021. Now, I thought by 2021, and I've told you this, we'd be above $2 trillion. I never imagined it could be 4. But that's what he just said. 10-year note going to be 6%. And my guess is the reason it's going to be 6% is because nobody wants it. Right? It's kind of like, look at Illinois and Chicago bonds. Right? You get a Sears. Sears is a great example. For Sears to borrow money, they got to pay like 11, 12% interest because no one really wants to lend them any money. That's what the bond king is saying. Be prepared. Be ready. Call us 800-951-0592. Take the time. Get prepared. Right? It really is. When you think about all the things that we've never done, that we're doing now, and somehow they're saying, hey, it's going to be okay. By the way, Ellen Greenspan just came out and told everybody to run. I'll tell you from what when we return. Final segment on this Tuesday, 800-951-0592. Give Wendy's going to be answering the phone, so give her a call. We've got a smorgasbord of deals. Too many to go into. We've got some 20s that we've got some 5s, some 10s. We've got a little bit of this, a little bit of that. Give her a call. She's wheeling and dealing all day today. This is one of those days. Great day to call. you're going to get a fantastic opportunity. Gold, 1,249. 12.49. It's up a little over $1.50, $2, depending on where you look. $1 to $2 on gold. Silver, just getting into positive territory. Just right now, 14.63. The Dow's up 200. We'll see. By the way, crude oil, it's getting a little worse now, down 5.3%. Crude oil down $2.60, $2.70, $47.26. Alan Greenspan came out with a warning today telling everybody, every stock investor to run away. It made me think about my uncle. Remember Eric's commercial, "We're right behind you"? That way, when we turn around and run, we'll be in front. Yeah, that's what Alan Greenspan's kind of letting you know today. If you want to be in front, because everyone's getting ready to turn around and start running. If you want to be in front, you better have some gold and silver put away. 800-951-0592. That is our toll-free number. Some of the things I didn't get to it I touched on it, didn't dig into it. Tomorrow I may dig into who's been buying the debt, and I've already kind of told you, listen, pension funds gave the illusion that people were, or that demand for treasuries was there. That's not going to continue, especially because these pension funds, even though, now the year's gone south. But look at Illinois as a great example. Do you know that Illinois, even though last year stocks were up 30%, even though they made everybody contribute more and they raised tax, did all this stuff, that the pensions got worse. And now 2018 looks like it's going to – this is the worst December in decades. And it looks like it's only getting started. And then tomorrow for sure we're going to talk about Goldman Sachs. Another banker, another story of corruption, and Goldman Sachs, this story is just starting to gain traction here. They're trying to blame two rogue traders, and now they may be being investigated for other crimes committed, not just against people, but against entire countries. The first one involving Malaysia. We talked about it briefly a few weeks ago. I got an update. I'll get you on that. But just remember, and I've said this all the time, you got to have your money in the bank, right? You got to pay your bills. You got to play the game. But only play it as much as you need to play, because it's froth. It's loaded with criminals. 800-951-0592. Patriot Radio News Hour. We'll be back tomorrow.